Something is happening in the gold market right now that most people are going to completely miss. And I want to be honest with you, I almost missed it myself. Because on the surface, everything looks like a reason to walk away. Gold just came off one of the sharpest corrections in this entire bull market. The headlines have been brutal. The talking heads on financial television are questioning whether the rally is over. And yet, when you strip all of that away and look at what's actually setting up beneath the surface, the technicals, the positioning, the institutional behavior, the macro backdrop, what you see doesn't look like a market that's falling apart. It looks like a market coiling, getting ready. And Monday's open may be the most important session we've seen in months. So let's walk through this together, because there are a few layers to this story, and each one builds on the last. And by the time we get to the end of this, I think you're going to understand exactly what's happening, and why the traders who are paying attention right now may look back at this moment as one of the clearest setups they ever saw. Let me start with the price itself, because context matters enormously here. Not long ago, gold hit an all-time high, somewhere in the neighborhood of $5,500 per ounce. That wasn't a fluke. That wasn't speculative mania. That was the culmination of years of structural demand building in the background. Central banks quietly accumulating, de-dollarization accelerating, institutional money finally rotating into hard assets at scale. The move was real. The fundamentals behind it were real. And then came the correction. From that peak, gold has pulled back roughly 25%. Let that number sit with you for a second. A 25% drawdown. In any other market, in any other asset class, that kind of move would be sending investors to the emergency room. But in gold, in the context of this bull market, that correction is actually well within the range of every major mid-cycle pullback we've seen in the history of this metal. And here's where the Monday setup begins to take shape. Because right now, as of this recording, gold is sitting right around $4,300 per ounce. It just bounced, and the bounce has a story. Before I get into that story, real quick, if you haven't already, check the description below. There's a free guide I put together on saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth from exactly the kind of volatility we're seeing. It's free, it's in the description, and if you're anywhere near retirement age, it's worth 5 minutes of your time. Now, let's keep going. So what caused the sell-off? Because that's the question that actually tells you whether the setup is real or not. If gold sold off because the fundamental case for holding gold collapsed, because inflation was tamed, because geopolitical risk evaporated, because the dollar reasserted dominance, then a bounce here is a trap. But if gold sold off for external, temporary, sentiment-driven reasons, while the structural case remained completely intact, then that bounce is something different entirely. Here's what actually happened. The Federal Reserve, under its new leadership, began signaling more aggressively toward potential rate increases. The market interpreted that as dollar bullish, gold bearish. And simultaneously, there was a partial easing of geopolitical tension in the Middle East, a preliminary agreement that temporarily reduced some of the fear premium baked into the price. Two headwinds at once, both short-term in nature, both capable of reversing, and the algos and the momentum traders all hit the sell button at the same time. That's your 25% correction. That's the whole story. Now let's talk about what didn't change, because this is where it gets interesting. Central banks globally purchased a net of 244 tons of gold in just the first quarter of this year alone. 244 tons. That number is staggering, and it comes after what was already a record-setting pace of accumulation over the past several years. These aren't retail investors panic selling on a bad headline. These are sovereign wealth funds. These are national treasuries. These are institutions that think in decades, not days. And they are telling you, in the only language that actually matters, which is capital allocation, that they believe gold is going higher. And here's something that doesn't get enough attention. Central banks now hold more gold in their reserves relative to U.S. treasuries than they have at any point since 1996. That's not a coincidence. That's a deliberate, coordinated, multi-year shift in how the world's most powerful financial institutions think about storing value. They watched what happened when Russia's foreign reserves were frozen. They watched the dollar weaponized as a geopolitical instrument. And the conclusion they reached, quietly, methodically, without announcements, was that hard assets held within their own borders were worth more than paper promises held in someone else's banking system. This is the fundamental backdrop against which today's technical setup is occurring. And now let's talk about the chart, because the chart right now is absolutely screaming. Gold dipped below its 200-day moving average for the first time in nearly 3 years. Now, for anyone who tracks technical analysis, that's a significant event. The 200-day moving average is not just a number, it's a signal. When an asset that has been in a sustained uptrend breaks below its 200-day MA, it usually triggers a wave of selling. Algorithms trip, stop losses hit, leveraged positions unwind. And that's exactly what we saw. The break accelerated the selling, which pushed the price down further, which triggered more selling. A classic feedback loop. But here's what the algorithms don't understand. Here's what the momentum traders miss every single time. The 200-day moving average is not a wall. It is a floor test. And the question is not whether gold broke through it. We know it did. The question is whether it holds here, whether this level becomes support rather than resistance. And the evidence we're watching in real time is suggesting strongly that it might. Think about 2008. Go back and look at what happened to gold during the financial crisis. When Lehman Brothers collapsed, when the entire banking system looked like it was on the verge of going down, gold initially sold off hard. Investors needed to raise cash. They sold whatever was liquid. Gold dropped sharply in a matter of weeks. And everyone who didn't understand the underlying dynamics looked at that move and said, see, gold doesn't work as a safe haven. Gold is just another risk asset. And then what happened? Gold went on to nearly triple from that point over the following 3 years. The sell-off wasn't a signal that gold was broken. It was a gift to everyone who understood what was actually happening. Or look at what happened in 1976. Gold had its first massive run after Nixon closed the gold window in 1971. Prices surged from $35 an ounce to nearly $200. And then came the correction, a brutal, grinding 47% decline that lasted almost 2 years. 2 years. The bears were triumphant, the gold bugs were mocked. And then gold went from $200 to $850 over the next 4 years. The correction was not the end of the story. It was the intermission. The pattern repeats because human psychology repeats. Fear and greed operate on a cycle. And right now, we are in the fear phase of a cycle that has not fundamentally changed direction. The reasons people started buying gold, the debt spiral in Western economies, the erosion of dollar reserve dominance, the rise of multipolar geopolitical competition, the structural inflation that refuses to fully die, none of those things have been resolved. Not one of them. They've been temporarily overshadowed by some short-term noise. And that's the setup. Let me talk about the institutional positioning, because this is arguably the most compelling piece of the entire puzzle right now. When you look at the COMEX data, the futures market, where the big players establish their positions, you see something fascinating. Commercial hedgers, the sophisticated money, the traders who actually understand the physical market mechanics, have been reducing their short positions even as the price has fallen. That's counterintuitive at first glance. Usually when price drops, you'd expect bearish positioning to increase, but instead, the smart money is getting less bearish. What does that tell you? It tells you they don't believe in the downside continuation. They're covering, they're repositioning, they're setting up for the next move higher. Meanwhile, look at what's happening with ETF flows. After a period of outflows that contributed to the selling pressure, you're starting to see stabilization. The marginal seller is exhausted. The weak hands have already been shaken out. What's left in the market are the holders, who aren't going anywhere. The physical buyers, the central bank accumulators, and the patient institutional money that has been waiting for exactly this kind of pullback to add to positions. Here's a specific dynamic worth paying attention to: the divergence between paper gold and physical gold. On the COMEX, you have contracts representing enormous quantities of gold changing hands every day. But the physical market, the actual buying of bars and coins and allocated accounts, tells a completely different story about demand. Dealers report consistent interest from buyers who aren't waiting for a perfect entry point. They're buying the dip. They're treating this correction the way a real estate investor treats a temporary market slowdown, not as a reason to exit, but as a reason to add. Now, let me connect this to something bigger, because the gold market doesn't exist in a vacuum, and understanding the macro context is what separates the traders who get this right from the ones who are always a step behind. We are living through a slow-motion reconfiguration of the global financial architecture. The dollar's share of global reserves has fallen dramatically over the past 25 years. What was once an overwhelming dominance is becoming something considerably more contested. Countries across Asia, the Middle East, Latin America, and Africa are actively reducing their dependence on the dollar-denominated financial system. They're building payment corridors that don't route through SWIFT. They're negotiating trade agreements denominated in local currencies. They're accumulating gold because gold is the one monetary asset that doesn't require trust in any particular government or central bank. And here's something that almost never makes it into mainstream financial coverage. The United States currently carries a national debt that is, by any historical measure, extraordinary. The interest payments on that debt are consuming an ever larger share of the federal budget. This is not a partisan point, it's mathematics, and the options available to address it are limited. You can grow your way out of it, which requires sustained GDP growth at a pace that the current economic environment doesn't support. You can cut spending dramatically, which is politically nearly impossible. Or you can inflate your way out of it, which means the purchasing power of dollar-denominated assets erodes over time. In that third scenario, which is historically the most common path for heavily indebted sovereigns, gold is not just a speculation, it's a necessity. This is why when Goldman Sachs puts out a price target north of $5,000 for the end of this year, and JP Morgan publishes research projecting prices approaching $6,000 per ounce, these aren't pie-in-the-sky predictions from gold enthusiasts. These are the most well-resourced research departments on Wall Street looking at the same macro data and reaching the same fundamental conclusion. Gold goes higher. The path is not straight. The corrections are real and sometimes violent, but the direction of travel is not seriously in dispute among the people who study this the most carefully. Now, here's where I want to speak directly to some of you watching this, because I know my audience, and I know that a lot of you are thinking about more than just trading opportunities. You're thinking about your retirement. You're thinking about what you've spent 30 or 40 years building, and whether that wealth is going to hold its value over the next 10 or 20 years. And that's a completely legitimate thing to be thinking about right now. Because here's the reality. Stock markets are pricing in a soft landing scenario that may or may not materialize. Bond yields are elevated, meaning bond prices are down from where they were a few years ago. Real estate in many markets has become difficult to justify at current valuations and current mortgage rates. And cash in a bank account is losing purchasing power every single year at an inflation rate that the official numbers may actually be understating. The question is, where do you put your money to protect what you've built? Gold is not a new answer to that question. It is an ancient one. And what's different now is that the mechanisms for getting gold into a tax-advantaged retirement account have become far more accessible. A gold IRA allows you to hold physical gold, actual metal, not a paper contract, not an ETF, not a derivative, within your retirement account structure. The metals are held in an IRS-approved depository, fully insured, fully allocated to you. And the hedging it provides against exactly the risks we've been talking about, currency debasement, geopolitical disruption, financial system stress, is the kind of diversification that traditional stock and bond portfolios simply cannot provide. If any of that is relevant to your situation, and if you're watching this, I suspect it might be, that free guide in the description covers how this works in plain language. Worth a look. Now back to Monday, back to the setup. Because I want to make sure we close the loop on the technical picture, because that's ultimately what's going to drive the price action in the near term. When gold broke its 200-day moving average, it created a situation where the price is now sitting in a zone that a lot of sophisticated traders are watching very carefully. The support zone around the current levels has multiple layers. You have the technical support from prior consolidation periods, you have the psychological significance of round numbers, you have the oversold readings on momentum indicators that suggest the sellers may be running out of ammunition, and you have the bounce that's already started, which is itself a technical signal. A market that has been broken doesn't bounce. A market that is consolidating before a continuation does. The setup for Monday is specifically interesting because of how the prior week ended. When you see a week close like the one we just had, with price recovering into the weekend after a significant overextension to the downside, it sets up what technicians call a potential reversal week. The market tested the lows held, and the close was constructive. Now Monday's open is the tell. If gold opens and continues to push higher, reclaiming territory above the 200-day moving average, that changes the narrative dramatically. Algorithms that were programmed to short the break below the MA will flip to cover, momentum will shift, and the next significant target, the midpoint of the entire correction, comes back into play relatively quickly. This is the moment where patient, informed investors often make their most important decisions. Not at the top when the headlines are euphoric and everyone on CNBC is talking about gold. Not when the price is breaking records and your neighbor is asking you how to buy some. Right here, in the quiet, after the fear, when the fundamental case is completely intact and the price has given you a second chance. Think about the people who understood gold in the late 1970s, when inflation was ravaging purchasing power, when the dollar looked like it might genuinely lose its status, when the geopolitical world felt deeply unstable. The people who held physical gold through that period came out the other side with wealth intact. And the ones who panicked at the corrections along the way, they got shaken out, watched the price recover without them, and spent the next decade wondering what they'd missed. History doesn't repeat exactly, but the rhythms are remarkably consistent. The same fear, the same capitulation, the same reaccumulation by patient capital, the same eventual recognition that the smart money was right all along. What makes this moment particularly charged is that we're not just looking at a trading setup. We're looking at a convergence. Technical signals pointing toward reversal. Institutional positioning shifting toward the long side. Fundamental drivers, central bank demand, de-dollarization, inflation persistence, geopolitical uncertainty, completely unchanged, and if anything, intensifying. Goldman Sachs holding a year-end price target north of 5,000. JP Morgan projecting towards 6,000. Morgan Stanley continuing to emphasize that the structural bull cycle is intact. These are not fringe voices. These are the institutions that move markets. And sitting in the middle of all of it is a spot gold price around $4,300 an ounce, down meaningfully from its highs, testing critical technical support, on the verge of either continuing to slide or reversing and beginning what could be one of the most significant recoveries in this bull market's history. That's the Monday setup. That's why traders who are paying attention right now are treating this week like a pivotal one, because the next several sessions will either confirm that the lows are in and the rally is resuming, or they'll tell a different story, and the tell comes on Monday's open. I want to leave you with one final thought, because it's important. Whether you're a trader watching this for the short-term opportunity or a long-term investor thinking about your retirement and your financial legacy, the question you have to ask yourself is very simple. Has anything about the fundamental case for gold changed? Is the national debt getting smaller? Is the dollar gaining share in global reserves? Are central banks selling? Is inflation structurally defeated? Is geopolitical stability expanding? If the answer to all of those questions is no, and right now every single one of them is no, then what we're looking at in the current price action is a correction within a larger bull market. And corrections within bull markets are not warnings, they're invitations. The smart money got that memo. The question is whether you did too. For those of you who stayed with me until the end of this video, I want to give you something specific. In the description below, there's a link to a free guide. And for anyone who watches all the way through, you qualify for something a little different. If you're an American retiree with at least $100,000 in any retirement account, an IRA, a 401k, a pension, anything of that kind, you can mention that you watched this video to get access to an exclusive one-on-one educational web conference. No obligations, no pressure, completely free. It's designed to walk you through exactly how the wealth protection strategies we've discussed today apply to your specific situation, what that looks like, how it works, whether it makes sense for you. The link is in the description. The guide is free, and if the one-on-one conversation is something you want, just mention this video and you're in. Pay attention this week. This is the setup traders can't afford to ignore.